Risk is really difficult to manage right now. As you just see this morning, one tweet can turn it all around. But I think what it's really getting at is just the fragility that we do see in the markets. And we're dealing with really three main issues. One is obviously geopolitics. And we're getting close to a point where the longer this goes on, the more things have to shut down. So just the different commodities that get produced out of the Middle East. You can take months to restart some of these things. But then layer on top of that some of the existing fragility that's already been in place, which is that equity portfolios were already highly concentrated to start with. And then AI is increasing winners and losers. And those moats that had been in place for so long, we're starting to question how durable they are.
Aside from the geopolitics, if we can put that aside just for a moment, how do you think about the U.S. equity markets versus the rest of the world here? We did have some outperformance in 2025 outside the U.S. Is that still in play here?
I think it should be. The U.S. is getting a bid right now. It could be because of what's going on with oil, but it also could be because that's where, as investors are taking in risk, that's where passive investing is. But I think there's a great opportunity to continue to diversify. With the U.S., you have this issue of concentration. 50% of the U.S. market is in technology. You go outside of the U.S., you get to exposures with different themes in financials, industrials, consumer.
But all of this, what's it, to borrow from the wonderful Arthur Levitt, so influential to me, from Arthur Levitt, what's it mean for Microsoft? I mean, March 31 is going to end. They're doing AI. They're still going to make revenue. They're going to still make 30, 40, 60% margins. What's the feature of life goes on here for the growth winners?
What you have to really think about with these growth winners is how are things changing for them? So we talked about this before in previous sessions, how much cash flow is plateauing now for these big growth winners because the amount of capex that they need to invest to keep the hyperscalers going and investing in data centers. That changes the dynamic of what they've had in the past. On top of that, these moats that some of these growth winners had is now in question. Can AI disrupt their ability to grow revenue without reinvesting in the business?
So that was a big trade just over the last several months. Kind of some of these software names in particular, software as a service names, really in focus. But it just feels like, as Tom mentioned, Microsoft, Salesforce, they're so entrenched in the overall economy. It doesn't seem like they could be at risk, yet the market's not too discerning at this point.
I think what we need to think about really are three ways of managing risk today. First of all, if you think about AI disruption and you think about inflation, what that does is it really focuses you on shortening your duration of cash flows. And you want to get to things that have more visibility around those cash flows. You need to think more critically about where to find defense, and then you need to be more intentional about diversification.
Did you get my script? Did one of our interns send my question script this morning? Nelson, you were with us with AllianceBernstein. Wonderful to speak to him with his acuity about risk probability and the ambiguity out there. Dow futures up 2%, exploding higher. What, Paul, 40 minutes ago?
Yeah.
A presidential tweet, a 5-day delay on action from the White House in Iran, in Israel, the Strait of Hormuz as well. Oil plunges a 113 down to a 104 right now. All weekend, led by James Dimon on the cover of Barron's, was the idea of hedging up. Explain the efficacy you see with all of your work and your math of saying, I want to participate in the Standard & Poor's 500, but I'm willing to give away some of the long-term capital gain to hedge and be less volatile. It's oh so in right now, isn't it?
Anytime you can reduce volatility, and also when you can reduce volatility and get incremental returns, that's a great trade. And if you think about international equity markets today, you have an opportunity, and I'd like to say, have your vitamins and also eat your ice cream. What you can do is there are some great catalysts outside of the U.S. That can generate returns. You've got in Korea, you've got in Japan, you've got governance reforms where shareholder returns are really being in focus, and these companies can not only get better returns, but also get multiple expansion. I think China could be a really interesting play here too. If you think about China, you've got a very different set of return drivers in China. You've also got more energy resilience based off of the infrastructure investments that they've made.
In the U.S., talk to us about the earnings in the U.S. marketplace. Are the earnings growth forecasts enough to support this market here, do you think?
There is enough growth to support the forecast, but it is very dependent on the Fed's ability to continue supporting that. And so I think that's why we're getting to a point where it's very tricky to understand the probabilities, because the longer this lasts, we don't know if inflation would start feeding through.
So what do you expect our Fed to do here? I mean, it seems like they're comfortable just to hang where they are. No need to rush. We've even had the marketplace pricing in some rate hikes this year.
Yeah.
I mean, there's a coin flip here.
It's in a very fragile balance. And so that's why I think it's important to look at visibility of cash flows from these companies with real assets and strong economic drivers right now.